All right, Atul Suri joins us to talk about trends, charts, market positioning, and more importantly, the market behavior. Atul, fantastic to have you back. Thank you for joining us. We are calling this show Coping with the Sell-Off, and this indeed is a sell-off.
Yeah.
Summer 2019, when Prime Minister Modi got re-elected, we thought that it would be an exciting summer.
Right.
It has turned out to be a painful period.
Absolutely.
What has gone wrong? Because if I look at the Nifty, frankly, you cannot call this as a bear market.
Right.
You look at the mid and small cap stocks, it is reminding you of what we saw in 2008. Excruciating pain, one-sided fall, complete absence of buying and only selling.
Absolutely. So essentially, today as we stand, it's exactly 3 months from the top we had at 12,100. So just let's look at these 3 months of underperformance. Nikunj, we hear a lot of headline global news. You get a lot of these WhatsApps, inverted yield curve, trade war, Trump tweets, Brexit problems. But if you look at global markets, they're doing pretty okay. The US is 4% from lifetime highs. In the same 3-month period, we are down almost 9 to 10%. And as you said, something like the small cap index is down 17% after a dismal last 1.5 year. So we've had our problems of pockets of problems that there are in the markets. However, what I think is that there is bad news that coming on economics, you heard GDP, etc. The market to some extent was expecting it. That is
this is yesterday's data.
Yeah, because the fact is that India has rarely, so out of the 25 global markets we track, barring Argentina, which has a problem, we are the worst performing market on a 3-month basis. So the fact is that the markets are beaten down in anticipation of data. Yes, it can be a little worse than what was expected, etc. Those are semantics. You'll have a 100-point Nifty move, etc. That's fine. But the fact is that the bad news was expected in the market. The thing is, what after this? Now, if I look at the market, I feel that what the market is looking for is action by the government. What I have been observing is that a sense of denial. We are the fastest growing economy in the world. Till I think a week ago, some bureaucrat was mentioning about it. And that, I think that bubble has to burst. The need to do something, government positive action is very, very important, because this, as we know, is a man-made crisis. There is no structural problem. Globally, markets are fantastic. There's a lot of chatter. But there is really no problem. You have crude below 60. You have bond yields that are tanking. Interest rates in India, for whatever it is, the rate cuts are happening. So it's very important to see government action. Now let me push this in terms of markets and Nifty, what I view. We are sub 11,000. What I personally think that 11,200 is a very important level for the market.
11,200.
11,200. See, we get to 11,1, 11,2 and we exhaust and come back. And this has been happening for the last 1 month. I feel that till we do not escape 11,200, we will remain in the bear grip. Mind you, bear market or bear shorting is tremendous. If you start looking at the data, there is a lot of bear hammering that is happening. To make the bears cover, you have to make them uncomfortable. And they're sitting on pots of money that they've made in the last 3 months. It's only beyond 11,200 that we will be out of the woods. So for me, that level is very important. But coming to the earlier point, that I think the market is extremely oversold. Yes, bad news was expected. Yes, things are not perfect, hunky-dory. But I think the silver lining is that if we see government action, good government initiative, good voices, it's just a sentiment issue. Everyone who's not even connected to the market is talking of 5%.
Everybody has a view on slowdown, whether it's real or whether it's not there.
Absolutely. Okay. And this was not known. It's not an unknown. It was known.
So are you saying that worst of the news sprint is behind us? Markets are a forward-looking beast.
Absolutely.
You never make money based on yesterday's data.
Right.
How much of the bad news is in the price? Can your charts capture that?
I think that a substantial part of the bad news is in the price. That is why I feel that even though bad news comes, we will sell off, but beyond a point, recovery will come in. We will fight. We will try to take out this 11,200, which I think is going to be a very important level for me to watch. And the sectors that I will look for, or spaces that I would look for, is essentially banking.
Because a common friend, Mr. Jhunjhunwala, told us exactly same time last week that he feels that 10,500 thereabouts is the bottom for the Nifty.
It is possible. It is possible. But the thing is that bad news is economically things are not going to turn by itself. You will have to see assertive action by the government, or the government needs to be seen acting. So I personally think that this market really depends on what sort of government action, what voices, what sort of body language, if you like to term it, is visible.
So are we in for a long winter?
It will take us time. It's not going to be a turnaround. Yes, if we cross 11.2, I think we can have a very good short covering rally, can take us to 11.6, 11.7 also for that matter, where everything will be forgotten because it will be 1,000 points from the base. But to take out 11.2 is very important, Nikunj. And why I'm saying this is because globally, things are good. Global markets, US is 4% from lifetime highs. For all the talk of recession and inverted yield curves, they're just 4% from there. So global markets are strong. The macros are okay. It's just that we need to be able to come out of this bear grip. And why I'm saying this bear grip is because if you look at data for the last 3 months that we are talking about, the FIs have some 24,000 crores negative, but the DIs have put in 30,000 crores positive. So your net institution inflow is there of 10,000
And I'm not
crores.
throwing in LIC and EPFO. If I add that data, the net liquidity actually from institutional investors may be surplus.
Right. And the nifty short position by FIs, it is a record. These oversold levels I last saw in 2013. And beyond that, I feel that when you have such markets pulled to one side, very often, if there is no disastrous news, see, that is something which is beyond our things. If there's some disastrous news, it's a different story. But if there is no incremental crisis, I feel that the markets will spring back by the sense that they have been pulled to one side far too much.
Okay, so I don't get this one wrong. Let's understand the scenario here, and because it's all about constructing scenario and then
that's right,
reacting
absolutely.
to that. Right?
Nobody has a perfect answer.
So scenario number 1, we don't see a rally,
right?
But we see a mild recovery.
Right.
Scenario number 2, this is the best which we'll get for the year, and now there could be a gentle or a gradual decline, and we may retest the earlier lows.
Right.
So scenario number 1, scenario number 2, which in your mind will play out?
I personally think that scenario number 1 will play out. The reason is that this 11,200, the level I keep mentioning, will break out not based on something spectacular happening in India, but I'm very bullish on global markets.
Okay.
I'm very bullish on US, I'm very bullish on the European markets. In spite of Brexit happening, you see the way the UK markets are there. So what I feel is that global markets look very good, and if global markets do rally from here, there is no reason why we will get so stuck or so oversold. So that is actually for me the biggest silver lining there is. In India, bad news will continue. These GDP numbers are not going to turn around. They can even get worse next quarter. But the important thing is that what sort of government action is going to happen. If there is no government action, or if there is no government pronouncements or urge to do something, I think that will be the
How
big
come
negative.
markets are not reacting to what's come out in the last 10 days? FBI tax has been reversed. I remember when FBI tax was announced, FIs, they started screaming, yelling, complaining.
It just sold
It's
off.
gone back.
That's
FIs
right.
have not come back last week. PSU banks merger. There seems to be a universal denial earlier from the government.
Right.
Now there is a widespread acknowledgement
Right.
that we need to do something.
Right.
So it's not that it's finger on the lips from the administration.
Agreed.
They're talking and they're working. So the government action which you're referring to, there's evidence of that.
Right.
It's just that markets have not reacted.
Because it will take time. They have been silent for far too long.
Okay.
Like you had an FPI tax, right? The day it was announced in the budget, 2 days later, we saw it in interviews that they realized they had made a mistake. It took them 1.5, 2 months to even say something about it. So they have been in denial. The fact is that if you have been in denial, so a band-aid is not going to solve it. You will have to put a plaster. So what you need to see is a lot more activity. Markets take time. And I think communication is a very important part of the game, which I find was very lacking with this
Tell
company.
me about your positioning. What are you doing for your clients? Long, short?
So essentially I'm a PMS, so I can't be short. I'm also sitting fairly invested. My cash levels are low, but my largest allocation is to financials in the private space and consumption. So consumption actually was a very difficult phase 2 to 3 months ago. Everybody was talking about, hammering consumption. It's over, it's over, it's over, it's over. But the numbers that came out for some of the consumption
Asian
stocks,
Paints, Nestle,
which we fortunately have in our portfolio, have actually propelled these stocks to lifetime highs. So there are a lot of these stocks that are touching lifetime highs. So they actually have really helped the portfolio in the last month. Financials, or what you call the private sector space, surprisingly, even the larger private sector banks have been a little on the back foot. In fact, if you ask me what is the cause of the recent pressure on the market the last 1 month, surprisingly, it is the private sector banks. You've had your Yes banks and RBLs, etc., of course. But even among the larger players, like even the marquee HDFC Bank, hasn't had a pretty month. the last month. Otherwise, this is a stock that always stands out as the first to rally. You're not seeing that kind of things. So what I feel, or what my portfolio of the last month has been spectacular as far as the consumption revival, because we were over at consumption.
Plus in the month of August.
That's right. It has been a positive month for us in spite of the index being negative. And
You were not short.
no, we are not short. And we are 95% invested. So we could also be, you are able to muster out positive returns in a very difficult scenario if you are in the right spaces. And for me, the right spaces, or I think which a multi-year theme for India, is consumption. Yes, you will have pains, etc., a lot of narratives, but I feel that this is a very long-term trend, and we are trend investors. I personally think it's a multi-year trend.
Now, you understand charts much more than anyone else I have interacted with. 95% of the market is going down. Some would argue is 99, I would say 95. Well, let's put a figure of 90, right?
Absolutely.
You are betting on the 10% market which is going higher.
Right.
You're betting against the trend.
Right.
That a trend watcher never does that.
See, essentially one is the market trend, where I take a view on the market, and that is if I'm trading the index. But I am trading bottom up in stocks. What you said is right, that my universe 2 years ago would have been 50% of the market. But as this prolonged down phase is happening, sadly or worryingly, this universe is compressing. And you're right that we are all stuck. All who are doing well in this scenario are stuck to that 5% of the market.
Doesn't make sense to do that. The last man standing will not stand forever.
No, Nikunj. Essentially, very often stocks that fall less in falling markets are leaders of the next bull market. If markets revive, these stocks could actually be the leaders. And there is always this, thing that, oh, they are very expensive, they've run up too much. But I have personally seen and I've been a veteran of many cycles, stocks or sectors that fall less in falling. Look at insurance as a sector. It is standing out so well in this market. And then you go down and look, yes, earnings have improved. Yes, under ownership. I mean, which institution investor has even 1% allocation? So the thing is that you have these themes you will set out. And as a portfolio manager, it's your job to protect the client's capital. These are spaces where hopefully the drawdowns are low. And as I said, when markets revive, they are the first leaders. So to fall less in falling markets, and the moment markets go up, to be the first to go up is what you're really trying to achieve.
Great point. So I'm going to spend some time here. Now, markets will recover. Whether it's today, tomorrow, this month, next month, we don't know. One day this bear market will become a bull market.
Right.
So you're making a case that the narrow stocks which everybody is criticizing, I mean, it's like this sour grapes, right? People who have them, they are not criticizing. People who don't have them, they're criticizing them. You're of the view that that narrow 5% or 10% will be the leadership sector whenever the bull market starts. So whether it is Nestle, Asian Paints, some insurance names, or a couple of private banks.
See, they will do well. And you have to look at things across cycles, Nikunj. If the market suddenly revives, you'll find that the beaten downs, mid caps and small caps will have high percentage gains. But it's important to look at portfolio performance across a cycle. 2 years ago, like all the kachra stocks were the best performing stocks. If you held all these stocks, you would be punished because they were actually laggards compared to this kachra stock. But when the cycle turns, and I've learned that you just cannot assess somebody on an up cycle. You have to go through a complete cycle. When the cycle ends, you really realize what are the compounding stocks. And net Nikunj, in India, if you see, big wealth has been created by 50 compounders. Yeah, the big wealth is created by 50 compounders, and these 50 compounders have always been expensive. I'm not talking about a phase. I'm talking about cycle over cycle, 10 years, 15 years, 20 years. That's what we are there for. You realize that ultimately wealth is created in these spaces.
Like a common friend of ours always says that a flat at Pedder Road will always be more expensive than one somewhere in suburb of Bombay.
It is a reality. It is unfortunately a reality. We get seduced into that phase. But the thing is that if you are patient and having, unfortunately in India, we have a certain generation, like our generation has seen a few cycles, and hopefully we learn from every cycle. You realize that these have been the wealth creation.
Maruti and Eicher 2 years ago, they were fantastic stories. They were the big boys, the real tall poster boys, great compounders, good company, directly on consumption. Maruti is down 50% approximately from its all-time high. Eicher 30,000 has become 15,000.
Absolutely.
What's going on with autos?
See, autos is like this 3 months phase we are talking about, where the index is down 9%, autos is down 17%. And all these marquee names, like I had them in my portfolio at one stage, but being trend investors, the trend changed, the earnings changed and price, so we exited them. So what you really see is that this sector, auto as such, again through experience I'm telling you, are a good 3 to 5 year kind of trends. And they almost double and halve in all these phases. They're very secular in nature. The important thing is to be able to some extent, even time it. And autos also are a very good proxy to your underlying economy and things like that. So auto, I always think, is a very good bellwether sector to see your overall economic cycle. And obviously the cycle, as we know, is struggling, and that is why, as a precursor, these stocks have corrected. However, the fact is, as you rightly said, that things will turn, things will change, and again these will emerge. When that will happen, we don't know, and that's our job really, to look at the kind of numbers they report and kind of trends that will play out.
So the stocks which you own right now, largely these mega caps or the 10% of the market,
Right,
are you
right.
happy to own them? Do you see there is enough and more visibility for 3 months, 6 months?
I think 3 years, 5 years. Because the thing is, again, as I know that, okay, today I'm outperforming, but when markets revive, you will have a relative period of underperformance because all these small and mid caps will spurt up too much. It is for you to have the maturity, it is for you to have a belief in your process so as to also go through those phases. Because as I said, when the cycle is over, you realize you're better off. You do get tempted to jump out, you get tempted to, be that cute guy and play that trade and do a quick pop, but it has never really made money, because in the top or towards the end of the next cycle, you always find you're stuck with kachra, where you never intended to be. And when the things turn, the tide turns, you're found swimming naked. So I personally, over the years, again, we are all growing here. You're growing, I'm growing as investors, markets are teaching us. You're just turning to learn that you have to be a survivor of cycles. And that is when fall less in falling markets, be the first to rise in when markets turn. That is really what I try to achieve for my fund.
Okay, so I'll divide the market into 3 parts. First, structural trends, where you think 5 year, 10 year, you can buy these trends not for yourself, but for your son and for your grandson.
Absolutely.
That's the structural part.
Right.
Then there are cyclical trends, where you could see a 2 to 3 year trend. And then where do you think there is scope for immediate gratification?
Right.
So how would you divide the market in these 3 components?
So I think the first category is where I would like to be positioned. I think we spoke of insurance companies. I think that's a very interesting space. Selectively AMC companies, again very linked to that, under-owned, and if you're talking about a whole demographic $5 trillion economy, these become very good places. Consumption selectively, yes, they will go through cycles, they are expensive, but you realize that over years they are the wealth creators. Financials, NBFCs, which are of very high quality, again expensive in PE terms, but you will have to bite the bullet at some stage. So I personally think that these are the spaces which tend to me to be the mega trends. That is where I am positioned, and that's where I'd like to be positioned. The pop-ups that will happen or the opportunities that can come, I feel that again quality, I personally think, again this is just guesswork, I'm not positioned in them, but I feel that the government will give a push to infrastructure. And I feel that infrastructure related, like the way I'm seeing some of the cement stocks behave, again, high quality cement stocks, I find a very good behavior, because when the markets are falling, they are really going sideways. Other players that will come into infra is something which, again, but stick to quality, because the price people have paid in being in poor quality is so heavy that people are not going to, or money is not going to follow bad quality for years to come. So high quality even in these spaces, and there are many.
Fair point. Okay. What about the beaten down, forgotten names, PSUs, utilities? Is there scope for them? Do you think the price correction in PSU banks, PSU utilities, PSU companies like ONGC, HPCL is just too overdone?
No, I think there are some PSU utilities, especially in the gas space and all, which are very, very interesting. I wouldn't take names for corporate governance issues, but there are some very, very interesting spaces. Yes, things like PSU banks, you've had an event, but they will take time, Nikunj, until the numbers don't come. Honestly, I'm a serious slave of numbers. Till the numbers don't come, who knows how long the winter is. And in some of these PSUs, like we've seen in case of MTNL, BSNL, Air India, great companies at one point in time, and they've just fallen off the cliff. So till the numbers don't come, if it's a PSU or private sector or a FMCG or consumption or insurance, ultimately the market is a slave of numbers. If you have trending earnings, you will have trending prices. Only that is what makes a trend. If you have trending prices, but you don't have trending earnings, it's very often a bubble, which we saw in the last 2 years. And if you have trending trending price, as I said, and earnings are not matching up, I would be very careful.
Yeah, I mean the P expansion happened and earnings never caught up. Now realization has kicked in.
Absolutely, yeah.
That's
so
a typical
you
markets
have to
move.
have earnings to back up.
Okay. I'll throw in some big sectors. Pharma is the sector now nearing the end of the decline.
Right.
And do you think there's still some more juice left in large cap IT?
So pharma is a very interesting sector. So on this 3-month basis, we said the market is down 9%. There is only one sector that is positive, that is IT. Okay. Thanks to these two large cap boys, right? And which is an institutional kind of stock. So now let's look at what has relatively outperformed. Pharma is down negative. It's still negative. It's still negative 4%. Now go back to a year or so. Pharma was the biggest underperforming along with PSU banks. So what I feel is that the rate of decline in pharma has reduced. You know, it is momentum. Ultimately, when you're falling, the momentum is high. But the basing out formation happens when the momentum of fall. So what I very interestingly find in this fall is that the momentum in pharma, the fall has declined. And I see it's interesting. Also, you know, there are some marquee names which are bottoming out, maybe not, time will tell. But there are some in pharma which are also on the other end of the spectrum, which are actually pushing to new lifetime highs. I have a couple in my portfolio. So I find that that could be an interesting space.
It was the first sector which in a sense started correcting. 2015-16 pharma started correcting.
Yeah.
Okay, what about IT?
See, IT, you have two spaces, the large cap IT and the mid cap IT. When you say large cap IT, everyone says it's expensive, over, etc. But honestly, that's the only place where people have been able to hold out and make some money. In the mid-cap IT, Nikunj, the volatility is very high. And if you get it wrong, and there are lots of these very good mid-cap IT space, but the hit you take, they just lose 30-40% there is. So there may be an opportunity there, but the risk is very high. So in IT, people have found refuge in these large cap spaces and they've made money. That is what really seems like, because that is where there is little consistency in numbers. In the mid cap, the volatility is so high that if you get it wrong one quarter, you're down 30-40%.
And that's too much of risk.
That is too much of risk and too much volatility. And in these times where where defense is very important, you don't want to be smart. If you're in a runaway bull phase, you can take that kind of risk, you can take that kind of call. But at the moment, defense is more important. These are times for Rahul Dravid and not a Virendra Sehwag.
Fair point. Okay, so before we wrap now, for India to do well, crude has to remain where it is.
Right.
And the dollar index has to remain weak.
Right.
A strengthened dollar index is bad news for not us, other emerging markets.
Right.
Before we wrap, let's get your thoughts going on those two. Normally we start our interaction with those dollar index and crude. Today, let's end the interaction with that.
I think crude is something that is headed lower. I think it's just under 60. I feel that crude will push towards 55. I think the crude charts on the longer time frame are fairly destroyed. The only negative can be some crazy thing goes wrong in the Middle East, which is geopolitical, and honestly there's no way anybody can predict that's going to happen. The risk among the two is the dollar index. The dollar index pushing 98, 99 is always bad news for risk assets. And that is where I am finding dollar right now, pushing that phase. But it has very often reversed from 98, 99. But the area which I would like to keep an eye on is the dollar index. Just to extend it to another asset class, which is precious metals. On a 3-month basis, globally, the space that has created maximum wealth is actually precious metals. It's gold. Gold has had a massive breakout above 1400. This is, I'm talking dollar denominated. In rupee terms, obviously, thanks to currency, it's done very well. I think gold is a very interesting space. Silver is doing a catch-up. Silver can be very fast and speculative, and over the last week, even platinum got into it. So as an asset class, globally as we stand today, precious metals is the area which is making wealth. A lot of people say, oh, if precious metals are doing well, then there's a problem for equities or commodities as an asset class. But I don't think it always works like this. Yes, you can draw correlations, but there are a lot of times where correlations also do not work. So I remain positive on US equities and I also remain positive on gold. It is a contradiction, but the world is not perfect in our markets. It's very dynamic, and I guess one has to adjust to it. Yeah.
And you know, before we wrap, Atul, frankly, look at all the reboots which have happened. When we started the year, the view was central bankers would increase rates.
Right.
The view was US will slow down.
Right.
The view was that India would accelerate.
Absolutely.
Look at what are we staring at.
Right.
It's been a synchronized bull market, if I may use the word, equities, bonds, gold. All asset classes broadly are in a bull run, and we are saying that's a bear market in India.
And you know, Nikunj, we are all become economists.
Exactly.
And for I mean, I don't have a degree.
Neither do I.
So the fact is, but today everyone, these WhatsApps, you get over the weekend, like they just take your breath away. The world is going to an end. Everything is going to an
And
end.
far too many groups, my friend.
Too
I
much.
appreciate your time. Thank you for joining
Nikunj,
us.
for having me.
That's it on this edition. Coping the sell-off, and that was Master Trader Atul Suri on beautifully dissecting the risk-reward ratio for long-term investors and for medium-term trend followers. Thank you very much for tuning in.